Hello, today we are going to jump into chapter 1, which is entitled Accounting in Business. And this is straight out of your textbook. I'm going to take you over to your shell and just reinforce one more time what the process is going to be as we learn together. And then I will deliver a lecture on the first 2/3 of the concepts in this chapter. So let's pop over to your Moodle shell so you can see what that looks like now that it's a little bit more filled in. So here we are in chapter 1, Accounting in Business. Again, your outcomes, and now your tasks are a little bit more built out. So you're going to listen to lecture 1, which is this lecture right here. And then you're going to do your homework, some homework in the book. Actually, this should say RQ. Sorry. So you're going to do a little bit of homework in the book to reinforce what you're learning today. And then you're going to check that in the solutions manual. And the solutions manual is right here. So when you're done with that, that's the first bit of facts for content for this chapter. Then you'll listen to lecture 2. And these are all numbered down here, right? Lecture 1, lecture 2, lecture 3. Then you'll listen to lecture 2, and then you will do the lab. And the lab's posted right here. And then you will listen to lecture 3 that goes over the lab together. You're going to need to read chapter 1, obviously, and then these 2 items here are in Connect. So that's how the unit's going to flush out. So without any further ado, let's go and take a look at the content for this chapter. So the first thing that I'd like to cover is just the very basics about why accounting is so very important and what do we use it for. And let's see. Sorry, I'm going to share over here. Share screen. So why is accounting so very important? Well, it is important because it's our way of taking what happens in a business environment and translating it into a way where we can communicate our financial results to people that are interested in the business. So some things that happen in the business world are reflected in the accounting records and some aren't. So like if I hire somebody, or if I sign a lease for a new building, that doesn't go in the accounting records. But when I run the first payroll for my new employee, that does. When I write a check for that lease, it does. So that's called recording the transactions. So who uses accounting information? All sorts of different people, right? External folks like people that own stock in our company or that have lent us money or that are employed by us, or external regulator agencies. And then internally, obviously, all the folks that are running the parts of the business, they want to get updated information so that they can continue to use that to make the business better and flourish. There's lots of different areas in accounting. Financial accounting is what this class is based on. We also use that information to manage our business. So these are different kinds of roles of managerial accountants. Ultimately, obviously, we have to prepare taxes for our business. So there's a lot of opportunities in accounting around taxation. And then there's just this whole slew of folks like entrepreneurs and people that litigate and researchers and such, consultants that also use accounting information as well. So as we are becoming more sophisticated with how we utilize data and manipulate data and launch analytical tools to help us run our business, through accounting information, This is called data analytics and data visualization. And these are definitely the wave of the future to make high-level decisions. Of course, everything, the thread that runs through all of our work is of high ethical paramount concern. So that's a whole nother class, business ethics, but it's inherent, obviously, in thoughtful and trusted accounting information. So everything that we're going to learn in this class, and this is a super important concept, is governed by this whole umbrella of rules and concepts and models and theories and constraints, and those are called GAAP, generally accepted accounting principles. And what this body of rules and models tells us to do is that we have to bring forth to our users of our financial information relevant, timely, trusted, and authentic, accurate representation of business results. And, which seems pretty obvious, but it's a little more complicated than that, because how do we actually do that? And lots of times I will tell you in this class, we do this, whatever it is I'm teaching you at the moment, because of GAAP. And that just means that's our body of rules that we have to follow. Well, where do they come from? They come from FASB, the Financial Accounting Standards Board, which is a group of folks that are appointed by the Securities and Exchange Commission. And the SEC is part of the federal government, and they make sure that any stocks that are traded on the public exchange, like the New York Stock Exchange or the American Exchange, are compliant with this set of rules called GAAP. So what is GAAP? Well, there's general principles and there's specific principles. And this might seem like, oh, blah, 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 but this is kind of the foundation of everything that we're going to be doing. So we do need to spend some time learning about what these are. So these are super important, each and every one of them. Let's start here. GAAP tells us we have to use the cost principle. The easiest way to illustrate the cost principle is if I buy a building for $1 million, I put it on my books at $1 million. And then let's say that there's a lot of upward pressure on real estate in my market. And a couple of years later, the thing's worth $1.2 million. But what the cost principle says is you don't go into your books and adjust that building for market value. You have to keep it at actual cost. So it's going to sit on my books at the $1 million as long as I hold on to it, regardless of what it becomes worth. Okay, cost principle, super important. Revenue recognition principle, equally important. It says that we recognize or book revenue, put it in our books, when we have provided the service, when we have earned the revenue. So if I do something that earns revenue, and then I send you a bill and you don't pay me for 60 days, I recognize the revenue when I bill you because I've completed the service. It doesn't matter when the cash trades hands. So that's a super critical concept. And right in there is the concept of expense recognition, which says, hey, same thing with expenses. I put an expense on the books when I have incurred it, not when I've paid it. So if you come and do some lawn work for my commercial building and you do $800 worth of lawn work, I have to put that expense in the books, even if I don't cut you a check for another 30 days. So that's really critical. Already you're starting to learn from these two things that it's not when cash trades hands, it's when the service is provided, revenue recognition, or when the expense is incurred, expense recognition. And then lastly, the matching principle tells us that we have got to match expenses in the same time period as the revenues they help to generate. Our assumptions are that the business is going to go ahead into the future much like it is now. We also assume that we're using monetary units. In America, that's the US dollar. We assume that the whole life of the business is broke up into time periods. For our purposes here, that's going to be generally be months, but you sometimes only close your books once a quarter or once a year. But in here, we're going to be working with months. And then it's also an assumption that a business is separate from its owners. So even myself and my business, Lisa Swallow CPA, PLLC, is separate from my personal checking account, my personal assets. There's different kinds of businesses. You can be a sole proprietorship, like what I just described. You can be a partnership. You can be a corporation where you have shareholders, or you can be an LLC. Constraints in accounting, this is also part of GAAP. We only spend time and effort getting together information that's going to benefit the reader. So if it costs me, a whole afternoon of time and it gives me a piece of information that doesn't matter at all, I have not complied with the cost benefit constraint. Likewise, materiality, we're really only interested in information that's big enough to make a difference. And that depends on the size of the business. In a little business, something, worth $20 might be material. But obviously, if you're doing Ford Motor Company's books, that materiality might be $2 million, right? So only information that influences decisions is disclosed. And conservatism is the theory that we always report revenues smaller and expenses larger. So we're keeping with a conservative approach to net income. Okay, so what we're going to be doing today, and if you'd like, you can get out a piece of paper and turn it so that it's landscape. We're going to be spending today looking at the accounting equation and actually physically working through it together. So the first thing that I would like to tell you is that the accounting equation is assets equals liabilities plus equity. And that is going to be the core of this entire class. So let's talk about what these things are. Assets are things that we own, right? Our building, our equipment, our computers, our cash, our accounts receivable, right? Somebody owes us money. That's a receivable. Receivables are always assets. We can also own assets that we don't touch, like that's intangible, like a patent or a trademark. Liabilities. Liabilities are things that we owe, right? And they usually have the word payable in them. Accounts payable, notes payable, mortgages payable. These are things we owe other people. It's debt. And equity is the difference, right? Here's everything I own. Here's everything I owe. The difference is equity. But then this gets even a little bit more complicated because equity itself has 4 components. Capital. This is the owner's investment in his or her company. Withdrawals. These are the assets the owner in the company withdraws. And then revenues, you've seen that word before. This is what I earn in my business minus expenses. This is what I incur to generate revenues. And revenues minus expenses is the same as net income. So equity gets a lot more complicated, doesn't it? The items in green make equity go up. The items in red make equity go down. And that's going to be very important. So I would like you to take your piece of paper and do this. Make a big statement that says assets and then leave some room, equals liabilities, leave some room, plus owner's equity, and then put the 4 things that I just talked about under there. This is going to be a tool. You're going to make this on a piece of paper. I'm going to give you a moment to just write this out. And this is going to be a tool that you're going to use as we go through and analyze transactions to see how they impact this equation. And remember, it's got to always stay in balance. So go ahead, take a minute, please, and do this. Okay. So I'm going to be going back and forth now. Here's your tool. You've written it out. And what we're going to do is go through some transactions and analyze them in the context of this equation. And right now, as I start, it's a brand new business. So I have 0 assets, 0 liabilities, and 0 equity. So my equation is in balance, right? Okay. My first transaction. Chaz Taylor invests $30,000 cash in a new business named Intrepid LLC. They provide web design consulting services. And now we're going to look at that tool that we just set up and say, hey, what did that do to the accounting equation? Well, my cash, which is an asset, went up. Chaz Taylor Capital, which is an equity account, went up. So let's put that in our equation that we just set up. So now we have to put some sub-accounts, don't we, under assets and liabilities. So let's go do that. So my sub-accounts are cash. These are kinds of assets, supplies, and equipment. These are the 3 things that I own in my business, or kinds of assets that we're going to be using. So put those in. And my liabilities are accounts payable. Remember that word payable is always in liabilities. And notes. Okay. And then again, we've already put in our 4 items in owner's equity. So I'm going to just move these down. I'll just keep this here. Okay. So in the example of Chaz just invested $30,000, that made our assets go up of 30,000, and it didn't do anything to our liabilities, so that's still 0. And it made our capital go up $30,000. So if you look at our equation, do our assets still equal liabilities plus owner's equity? And they do. Number 2. Transaction number 2. This time I purchased supplies for $2,500 cash. What happened? Well, I'm going to go look at my sheet. You should have this sheet sitting in front of you, and you look like, did it impact assets? Well, sure it did. I wrote a check for $2,500, so my cash went down. And then what did I do with that cash? I bought an asset called supplies, so that went up. So let's go and mark that on our equation. So my cash went down by $2,500. So you've got to put a minus sign, right? It went down. And my supplies went up. So now I've got to balance my whole equation out. Make sure everything still makes sense. So 30,000 minus 2,500, I can write the word balance in here. Looks like I've got 27,500 of cash, 2,500 of supplies, 0 equipment, 0 AP, 0 notes payable, 30,000 in capital. So the question is my accounting equation still in balance? And it is. Awesome. I'm going to go now and see what my next transaction is. It looks like the next one is I bought some equipment for 26 grand. So I'm going to give you a second. You can turn off the tape if you'd like. And please go book this on your transaction analysis worksheet, that tabular formation we're working on, and then do the totals like I just showed you so we can see where we're at now. So you can turn off the tape and go do that. So I spent 26,000, so my cash went down. Nothing happened to my supplies, but this time I bought 26,000 in equipment. Nothing happened over here. Okay. So let's go and balance this out. Just get rid of some of these lines so that we can see all this. And I'll make my balance line bold. And so here I am. It looks like I've only got 1,500 in cash left, 2,500 in supplies, 26,000 in equipment, and nothing's happened over here yet. No AP, no notes, and $30,000 still standing in my capital, right? Is my equation still in balance? Do my assets still equal liabilities plus equity? And it does. Okay, great. Next transaction. Transaction 4. This time, I bought some more supplies, but I didn't pay cash. I pay, it's on credit. That term gives you a hint that I need to increase my liability of accounts payable. Accounts payable is when I owe somebody money for something that I've either bought from them or a service they provided me. So please go to the accounting equation, turn off the slide or turn off the tape and record this on your tabular format, and I'll meet you back there. Turn off the slide, the video. Oops. Okay, so what's happened here? Change this. Notes, I can buy myself some space. Okay, so I've purchased $7,600 or $7,100 of I've purchased my $7,100 of supplies, so I've got to increase that. But I didn't pay cash this time. I have to go over here and increase my liabilities. And I think I'll put an equal sign here so you can see we've got to keep, these are my assets, these are my liabilities. I've got to keep all of this in balance. So now let's go balance it out. I've still got 1,500 bucks in my bank account. I've now got $9,600 of supplies. I still have my 26 grand in equipment. Okay, but now I've got $7,100 in debt, don't I? I don't have any notes payable, and the difference between a notes payable and an accounts payable is that notes payable is a formal instrument that you sign, and it's got interest on it. and it's got terms on it, like, 90 days or 2 years or whatever. Accounts payable are just trade payables that are very, very common when you purchase things on account. And of course, I've still got my 30,000 over here. So let's do a quick balance here. Do my assets, and so take a moment, add up your assets, and make sure that that still equals your liabilities plus your owner's equity. So do that, please, and make sure. Now we're going to transaction 5. Wow, finally, no, let's see. Finally, I am earning some revenue. I am a consultant, if you remember web consulting. Looks like I put in 30,000 of my own money. I bought my equipment, I bought my supplies, I'm ready to roll. And now I've actually got a customer. And I provide my service, and she pays me $4,200 immediately. I don't even have to bill her. She gives me the cash. What does that do to my accounting equation? Well, my cash went up, and I just earned some revenue. And remember, that's one of those 4 subsets of equity. So let's go over to our tabular format together and enter that. Okay, cash, 4,200 bucks, awesome. All the way over here, remember this? Revenue. And just to refresh, all 4 of these items are each of them are a part of owner's equity. So over here, my revenue, I think I'll just get rid of this, went up $4,200. So make sure to fill that in, okay? 4,200 bucks. And then let's do our balance. Always got to balance it out. How much cash do I have now? Supplies are same. Same. No notes. Owner's capital, same. And now I have revenue as well. Bold, and then please run a calculator across it and make sure that your assets equal your liabilities plus owner's equity. And I'm going to just do a quick calculation here. So 5,700 plus 9,600 plus 26,000, 41,300. Does that equal accounts payable plus owner's equity? Yes, it does. 41,300 on both sides. My accounting equation is still in balance. Awesome. What happens next? The company paid some rent of $1,000 and salaries of 700. Now, what happened? This gets a little interesting, so stick with me here. Clearly, my cash, which is an asset, went down by 1,700 bucks, right? Because I paid some expenses. Okay, but what's kind of weird now is my account of rent expense and salary expense. Obviously, those expense accounts just got higher, right? Because I've incurred expenses. But what's kind of funky about expense is, what does expense and withdrawals do to equity? It decreases it. Okay, so let's go look at that together. Again, under equity, capital and revenue increase. Wait, how much should I do to make this? Increase equity, right? So maybe we'll just put that down here. Increase. Increase. Whereas expenses and withdrawals do what? Decrease equity. So even though the expense of rent and salaries went up, the effect on owner's equity is to go down. So let's start over here with the easy part. What happened to the cash? Right, one more time. What happened to the cash? My cash went down by $1,700 and my equity went down by $1,700 because these two expense accounts went up. So cash decreased $1,700. And then over here, my expenses decreased equity. And we know that because right here it says decrease, expenses decrease equity minus $1,700. And again, just as a refresher, revenues minus expenses equals something called net income or loss. All right, let's go balance. How much cash do I have? Go ahead, turn off the tape, fill this in, and then run a calculator over it and make sure that your assets still equal your liabilities plus owner's equity. So shut off the tape and go do that. Okay, so I'm running the tape across my assets, 4,000 plus 9,600 plus 26,000. So I'm just going to pencil that out. I've got 39,600 in my assets right now. On the liability side, I've got 7,100 plus equity is 30,000 plus 4,200 minus 1,700. Awesome, I've got 39,600 on the right side of the equation as well. Let's go to the next transaction. Okay, now my company Intrepid provides consulting services of $1,600 and also rents out some of my spare square footage for $300 to a customer. So two things happened. I provided some services, right? My web consulting, that's what I do. And then I also have a little bit of square footage in the back of my office and I rent that out for $300. And I do all that on credit. They're not paying me cash today. I have now an account receivable and that is an asset. And this means that I have an asset that gives me the right to get $1,900 from my customer. Let's go book this on our sheet. So did I get cash? No. Did I get supplies? No. Did I get equipment? No. I have to add a new asset and there's nothing magic about adding a new asset. I'm going to put it right in here. Accounts receivable. And that is from here on, I will write it as AR. That's what it's known as. But for the first time here, when you're seeing it written, we'll do it as accounts receivable. Okay, so this is my AR just went up by $1,600 for the web services and $300 for the rent. So my asset of AR just went up. Didn't impact my liabilities. I don't owe anybody anything. They owe me, which is a receivable. A payable is when I owe them. A receivable is when customers owe me. And now I'm going to go over here to my revenue. And I earn two kinds of revenue. I earned consulting revenue, and I earned rental revenue. So for our purposes here, I'm just going to put them together, but be aware that as we get more sophisticated, those are two different accounts. Okay, now let's balance. You know what to do. Shut off the tape and go balance. And you can see here, I'm going to run my calculator over it, and I am still in balance with 41,500 on both sides of the accounting equation. So life is good. All right, we're going to do a couple more of these, and then you're going to go spend some time practicing this on your own with some homework I'm going to give you. Okay, next equation. Our next transaction. This time, the client that owes me that $1,900 that we just put in the books, she pays me. She pays me the $1,900. So my cash just went up. My asset of cash went up. And my asset of accounts receivable went down because she just paid me. I don't have that asset on the books anymore. So let's go do that. Cool, $1,900 of cash. Decrease of my asset of AR. Nothing changes on this side of on the right side of the equation. And therefore, life is good. I'm still in balance. $5,900 of cash, same supplies, same equipment, no AR, and everything's the same over here. See how this is working? All right, we're going to do one more. I'm going to have you do it on your own, and then I'm going to give you the assignment that I'd like you to do before you listen to tape number 2. Okay, please go ahead and do this equation. I owed my company Fast Forward, if you remember from transaction number 4, I bought some supplies on account from them, and now I'm paying them. Okay. I'm paying part of my accounts payable off. So please think about that. I'm paying $900 as partial payment on that amount that I owe one of my vendors. Please book this in your sheet. Turn off the slide or the video. Balance it out. And voila, we are still in balance. Run a calculator over both sides, do all your assets, equal liabilities plus owner's equity. And the answer is yes. Final transaction. The owner, Chaz Taylor, decides that he's going to take out $200 for himself. That is a decrease in equity. Withdrawals even though the account, this is like an expense, remember this kind of funky one, yes, the withdrawal itself got higher, but withdrawals and expenses decrease equity. So total equity decreases because withdrawals cause equity to go down. Book this, balance everything, and we will be at the end of this video. Okay, I'm going to run my final tape and make sure that my accounting equation is still in balance. So on the asset side, 4,800, 9,600, 26,000 is 40,400. My liabilities total 6,200. And now I'm going to pull my everything in equity together, right? Because remember, these are all subsets of equity. Revenue minus expense equals net income and loss. And the capital minus the draws are also part of this. So I'm going to take 30,000 and subtract 200 bucks of draws. And then I'm going to calculate my net income or loss, which is revenue minus expenses. So that's 4,400 bucks, right? So I'm going to add that, and my equity is 30,000 minus 200 plus 4,400. My equity is 34,200. My liabilities are 6,200, and both sides of the accounting equation balance at the end of the day. 40,400 in assets and 40,400 in liabilities plus owner's equity. So everything that has happened in my accounting equation balances out. Assets equals liabilities plus owner's equity. So now it's time for you to practice. You should go do QS1-11, E1-7, E1-15. It's imperative that you do this. This is the whole way that you will learn this. Watching me do it is not going to teach you how to do it. You need to go do these and then check your answers against the solutions manual. Then you will be ready to listen to lecture 2, which takes us from all of this work onto the financial statements. So I hope this has been really helpful, and I look forward to seeing you after you've worked through that homework, checked it against the solutions manual, and are ready to hear about financial statements. Bye.